what I want to point your attention to is how does the market actually do during those periods of pauses? Look into 2006, 2007, 2008. Here's the pause. What does the market do? Market is actually still going up. Very interesting. And we are at the end of the tightening cycle. We are at that pause already. So we always state with Bruce that the market could go up when the Fed is raising the rates. But here it's already at the pause and we're still going up. So that's another evidence that the current bullish environment could persist even during the Fed pause. The same has happened during 2019 of the 2018 low. Look at how we're not only we're going up, we're actually producing a momentum swing up. So that's also very interesting. And look how even after the decline, we're still going up until COVID hits us. So many questions here, Bruce, as to how the market could react. But these two instances where the market is going up just tells me that, you know, there could be a pressure from the Fed. They could be very restrictive, and yet the market, especially behind the still strong consumer economy, could still go up.
We had said at the time, I believe, of the last Fed meeting that they were done raising. And part of the logic for that really came from the relationship of these two yield series. And we look at the 2-year yield and we see that as soon as it stops rising, goes sideways or starts down, that the Fed stops raising. Jeffrey Gundlach would say, get rid of the Fed and just follow what the 2 years doing. And this would tend to make that case. Powell was doing kabuki theater today. And that was that he was getting up there and he was talking tough. We're going to raise again. We're going to raise 2 more times and all that. And then people were saying, well, that there's like in the data, it shows that there's going to be 5 rate cuts in 2025. Who knows? But the point being that the 2-year has stopped. And it had one little spike up at the beginning of the year in the first quarter. Now it's made a lower high and it's in a sideways action. So the Fed is doing what they do, which is to follow the rates. Now, the Fed, as we can see here, could be in sideways mode for a quarter, 6 months. There's even examples of even longer. But once you start to get the 2-year falling, which is something we're going to watch closely, that's when the trouble can start. Well, we're going to talk about this in the business cycle class. Employment data is a lagging data. It's a lagging effect of the business cycle. The best thing that could happen is that the 2-year just stays at this level. And as Ramon just said, that the market could be in a position where it could continue to rally in a benign sideways environment like that.